Very good evening, colleagues, to all our colleagues on the platform. Welcome to our webinar hosted by the BMF in collaboration with Graviton, a company that is a member of the Sanlam Group. And as you would know, BMF and Sanlam have a very intimate collaboration dating back many years. So a very good evening to everyone on the platform and all the colleagues from Sanlam as well who are around. A very warm welcome to you, and a warm welcome to our panelists who have joined us this evening, who will shed light on the selected topic and obviously give a deeper insight of the industry and of the business that they represent, and what they can offer our members as well in terms of their value proposition. So a very warm welcome to our special guests from Graviton and from Sanlam as well, Mr. Stuart Mayer, Tato Mashiko, and we also have another colleague from Sanlam as well, Mr. Stuart Spice as well, who can also take comments and input as well along the way. First and foremost, before we get underway, apologies from the BMF president who was unable to join us this evening. He's caught up in other engagements, but he's wishing us well for this evening's engagement. Secondly, when you look at the title for this evening, the post-COVID retirement saving strategy, the do's and the don'ts. Of course, everyone is caught up in the post-COVID thinking, mentality, and all the challenges that we've faced. And when you begin to talk about retirements and savings, you're now beginning to deal with a highly specialized environment, highly specialized thinking. Of course, it deals with different kinds of financial products and key decision-making about how to spend money. And so it's quite key and pivotal for our membership, both corporate members and individual members, in how they think about financial disposal and thinking about how to deal with retirement and savings post-COVID, which is going to be quite a challenge. And so we're looking forward this evening to hear the insights of our esteemed colleagues on this very key issue, which is key for the BMF, key for our members, and key for the broader South African public. And also as well, the whole issue of the membership that we have and what BMF represents out in the marketplace in terms of the quality of the membership that we have. And of course, it is the middle class that you're talking to and some top end members as well. And so we are representing quite a specialized task force, so to speak, the middle strata in South Africa. And we've got special responsibility on our shoulders in terms of understanding certain things of a financial nature and how to make decisions and how to dispense that thinking across our value system, so to speak, and within our networks as well. So I'm quite excited this evening to be a listening ear as to what the colleagues have prepared for us and what they want to bring across. Again, I was requested by the BMF to also state that this is the first of these engagements. It's not going to be another one-hit wonder type of event or webinar, but it's going to build up further in terms of having more engagements of this nature to further understand the whole industry of retirements and savings, investments, etc., for our members and broader South African public. I just want to mention one thing. I did have a look at the Graviton website, and I just wanted to find something quite interesting, which maybe our audience may not know. So the first thing I noticed was obviously the corporate colors. It's very similar to Sanlam. But secondly, in the word Graviton, the letter I is in blue. And I found this interesting thing that it is emphasized because Graviton is driven by independence, interdependence, and individuality. And I thought that was quite key and quite interesting to discover that indeed you are driven by the triple I's, so to speak. Independence, independent thinking, independence in your product offering, interdependence as well, across your own value chain, so to speak, and individuality as well. And so the BMF also resonates with some of these I's, that the BMF itself is an independent organization, thinks for itself, is also interdependent as well with other organizations connected to them in making the necessary impact in South Africa. And it also is individually driven. In other words, the membership is individually driven. The individual member builds their value as well within the organization. And so as a member, you can join a webinar or you can join this and be part of that. So there is that element of an individual that we will not drag our members into things, but our members themselves must be conscious enough of the personal responsibility that they have to themselves, their own personal development, and also to the cause of the Black Management Forum. Having said that, I would like to bring onto the platform our first speaker, Mr. Stuart Mem. He joined Graviton in 2016. He is currently the head of business development, and he has been in the industry for quite some time, around 12 years at Investec, and he holds a BCom honors in investment management and NQF level 4 in wealth management as well. So Stuart, welcome and thank you for gracing us with your presence. The platform is yours.
Thank you, Monde. Let me just share my screen quickly to get the presentation up. And thank you, members of the forum, for this evening and for the opportunity to present on our business and what we're about. I'm just trying to get the screen up here. Give me 2 seconds. Okay. Monde, can you see that screen?
Yes, we can see it.
Fantastic. Thank you, man. So thank you all for the time this evening. I think the most important point to start with is, why Graviton? Why do we have the podium this evening with Sanlam Private Wealth? And it really, the second you've got retirement strategy on a docket or on an agenda, I think that's where the why is answered. Our business, was started as Chorus Capital, a financial advice proposition, talking to members of retirement funds administered by Sanlam, in effect. And 7 years later, we consult to over 200,000 members of retirement funds, which I'll talk to in the next slide. And our vision and core to our business is really walking a road with members, both pre and post retirement, serving the retirement funds that we are linked to, and helping those members retire with dignity and peace of mind. And as I go through the presentation, you'll see that that's no mean feat in South Africa. There are very small. There's a very small percentage of our population that actually retires comfortably. That is a problem, and it's something National Treasury has even identified and is looking to tackle. But that's our bread and butter. That's why we wake up in the morning, and that's what we think of when we go to sleep. So this really is a forum that we talk to and hold dear to our hearts. We are owned by the Sanlam Group, and we act independently within that, as Monde highlighted. But we proudly talk to our Sanlam Association, and it allows us to pass on many of the benefits afforded by Sanlam to our advisors and ultimately to the clients that we talk to at the end of the day. So just to give you some sort of broader context there, these are some of the funds that we are appointed on, or at least that we talk to. The likes of Massmart, Coca-Cola, ArcelorMittal, SAB, and others that you can see there. And the only reason I'm showing this slide is to say, is to give context to the next slide in terms of, we really understand the retirement landscape and where it is at the moment, and the challenges facing it, even before COVID. If you look at COVID specifically and what it's meant in terms of capital markets, we're not too far off where we were before COVID domestically, and offshore we've actually surpassed where we were. So I think the challenges are more sort of structural and economic, as we all know. From a retirement point of view, tonight, it's important to cover the basics, to make sure the basics are understood and applied, and then to start talking to some of the specifics. So this slide is courtesy of some information that was surveyed in the Sunland Benchmark Symposium, which is an industry-leading survey conducted in the employee benefits landscape. And basically, it surveys retirement funds, principal officers, retirees, members, just a broad scope of industry. And it asks specific questions to get some feedback on the state of affairs. And you'll see there's some pretty concerning statistics there. I'm not going to talk to all of them, but 51%, for example, of retirees can't make ends meet in that survey, which we think is representative of the industry. 67% have no retirement plan. And at the top right there, only 6% save enough to retire comfortably. So that's a huge concern and really a number that needs to improve. This graph at the bottom really talks to the investment life cycle as we see it. This accumulation phase that retirement members have up until the age of 65, in some instances 69, depending on the rules of the fund. Before you decumulate, and decumulation really means before you draw on the savings you've accumulated in retirement, and that's where saving ahead of that time is critical. So just again, talking to the basics and what's needed, and this also talks to the do's and don'ts per the invite that was sent to you. So there are do's and don'ts that are highlighted here. First and foremost, start early. On average, retirees start contributing at the age of 25 and save for 35 years towards retirement. If you do the math there, that could actually be 40 years if you consider retirement to be the age of 65. And we know that not everyone starts at 25. So these are the habits you need to get into early on and as early as possible, which obviously leads to compounding your investment over time. Save as much as you can, and we all know that's easier said than done. But just to give you some context, the retirees believe that you need about 14 times your final annual salary at retirement. And importantly, to highlight, this is to maintain your standard of living. So you can retire on less, but your standard of living would need to make up for whatever the shortfall is. 14 times is sort of the industry accepted industry number to maintain your standard of living. Just going to move this quickly. Don't rely solely on your company retirement fund. So 42% of members surveyed complement their provident or pension fund with a retirement annuity. And that certainly is where our advisors, Stuart on the call, and Lungisa, who unfortunately submits his apologies for tonight, but they are certainly able to assist with that. Leave your savings alone. I've got a slide solely talking to that because it's underestimated. So I'll expand on point number 4 in the next slide. Widen your net. If you can supplement your retirement income from other investments, it's always a good thing to do. Some guys have property portfolios, others have other businesses that they run. If you can supplement your income, it's great to do, and it also diversifies your portfolio. Use the professionals. I'll certainly expand on that a little bit. Again, I'll introduce 2 of our seasoned campaigners to you at the end of this presentation. But the point about retirement saving is it's also governed by regulation. And you need to ensure that the retirement vehicles you use comply with Prudential Investment Guidelines and the Pension Funds Act. which sounds like a complex process, but it's not complex if you use the right advisors and invest in the right portfolios. And then make sure your money grows. There's no substitute for a quality investment. And if you invest with the right people, right channels, the right resources, you should expect a real return on your investments, and for that investment to compound over time. And that's how you make sure you're part of the 6% to retire comfortably at the end of the day. So just expanding on point number 4, leaving your savings alone. 70% of retirement fund trustees that were surveyed in that benchmark symposium believe that not preserving fund benefits is one of the biggest mistakes members make. And 70% of those members surveyed took some or all of their benefits in cash when withdrawing from a retirement fund. That has huge implications for retirement, but there's also implications there from a tax point of view before retirement if you access that money. Again, they're not for tonight's discussion, but our advisors are very, very happy to engage with you on that if you want to unpack that detail. I just thought I'd take you through a working example of the implications of accessing that money instead of preserving it. So what we have here is 2 scenarios of the same individual, Tembi. On the left-hand side, scenario 1, Tembi preserved her savings through her career. On the right-hand side, Tembi accessed her savings, her retirement savings. So at the age of 25, when Tembi started her first job, and sorry, the assumptions on both sides are the same and are highlighted on the right of the slide. All realistic assumptions in terms of return, salary and contribution rate. So it's a good working example. At the age of 32, Tembi gets retrenched and she finds a new job. On the left-hand side, she preserves her savings. On the right-hand side, you can see she withdraws savings. Okay, so basically starting again at the age of 32. At the age of 43, she resigns and starts a new job, but preserves her savings. On the left-hand side, scenario 1. Scenario 2, accesses her savings again. And the net effect, which you would expect, is that, fast forward to retirement at the age of 55, and Tembi has 3 times more to retire on in scenario 1 versus scenario 2. And that's purely the power of compounding. On the left-hand side, letting your return compound on return, and on the right-hand side, accessing that investment, you take away the power of compounding. So it's really, a discipline to exercise as far as possible, notwithstanding the challenges out there, which we're also aware of. The other point I wanted to just unpack a bit is the return on the underlying investment. So you might hear the term replacement ratio thrown around quite a bit when it comes to retirement savings. And, replacement ratio really is the percentage of your pre-retirement income that you need to maintain your standard of living in retirement. And in industry, that's widely regarded as 75% of your pre-retirement income. But to get to that outcome, you need to ensure that you're earning a real return on your investment over the long term. That is certainly in the region of 7% plus, and that's over the long term. So the return on your investment is hugely important, as is starting early and not necessarily accessing your savings along the way. And in our world, there are a number of reasons why we feel our advisors are equipped to deliver on that responsibility. And the first point to make is our advisors leverage into a multi-manager in Sanlam that talks to 150 billion rands worth of assets, approximately 150 billion rand. And that allows for scale benefits that are passed down to end clients at the end of the day, because it comes with pricing power. So, we build and manage solutions with our advisors where any fees we negotiate with asset managers are passed down to them and then down to their clients at the end of the day. So size does matter in this world, and certainly with the backing of Sanlam, we do have scale, and we leverage that to the benefits of our clients. We've also got a strong investment team, which comprises good experience and youth, and really this just ensures that in terms of for example the implications of COVID and investment strategy post COVID, that's this team's responsibility, and they make sure that our advisors are equipped with the right tools and the right research and application to give best advice to end clients at the end of the day. And it helps to leverage off a team that has a lot of depth and a lot of experience in that regard, because the markets aren't still, they do change, and you need to keep pace with them. Okay, this is just a live example of two of the solutions that we do manage and maintain with two advisors in our Graviton Wealth brokerage, and I'll introduce them after this slide. Both of these models are compliant with the regulations that govern retirement funds. So both of these models are built for purpose and have outperformed their benchmark significantly if you look at this top gray line versus the benchmark in blue. So this is delivering on the objective to do to provide you with that return through your accumulation phase. And again, this is something that the advisors in our stable would be happy to engage with you on if you needed some sort of introduction. And those advisors, just in conclusion, are Lungisa Mbuli and Stuart Spiss. There are their contact details. I'll make sure Mondi gets this presentation, and they are more than happy to engage with you around broader, retirement planning and how to go about it, building on the basics that I've introduced this evening. Just to close, this is a quote from the CEO of Sanlam Investments, who's a director on our board. And I think it talks very appropriately to the fact that Sanlam Investments as a business is well positioned to leverage its capabilities and its credentials beyond the traditional retail world and model. Sanlam Investments has invested a lot into being future fit, and I think that's going to pay off, particularly on the back of what's happened this year, and even before that, on the back of markets locally that weren't necessarily delivering where the traditional asset classes are concerned. So thank you, Mondi. Thank you to the forum. I'll stop sharing my screen now for the next speaker.
Thank you, Stuart. I think that some very great principles there that you've outlined. I just want to remind the attendees that we'll take Q&A after Mr. Mashiko has given his presentation for the gentlemen that are on the platform. So as we are going through their presentations, please make use of the facility here in posing your questions or even comments as well are welcome, so that when we get to the end, we can engage. And obviously, they are here for you. They're here for the members that are on the platform to engage them. And so we'd then move very swiftly to Mr. Tato Mashiko. He is currently portfolio manager at Sanlam Private Wealth. He's the official spokesperson as well for Sanlam Private Wealth. He has about over 10 years experience in investment industry. He's a member of the Transformation Subcommittee for Sanlam Investments Group. He represents Sanlam at the Black Business Council. Very interesting fact here, he's a former blackjack dealer at a casino in the United States. He's a former English teacher as well in China as well. He's also had an interesting stint as an associate producer in the film production industry. He has a passion for education and currently also teaching finance part-time. He holds a B Social Science PPE degree. He also holds a BCom honors. He also has a CFA certification, CAIA as well, and also a board member of CFA South Africa. Mr. Mashiko, thank you very much for your time. We are looking forward to your engagement, and the platform is yours, sir.
Thank you, Monde, for that introduction and highlighting the journey taken. I suppose everyone has their own journey to arrive at where they find themselves in life, and no one's journey is a straight line. Similarly, investments are never a straight line. And so in some ways, investments and life do mirror themselves in that way. So in terms of what I'm going to be speaking on, the topic is really around investing in a post-pandemic world, or rather, how has COVID-19 impacted on investment markets? And as Stuart recently alluded to, obviously, the retirement industry's objective is for people to retire comfortably at some point in time, and you save money over a number of decades, and hopefully that capital grows. So it's individuals like myself and fund management companies which endeavor to grow capital over time according to a certain target rate, whether it's relative to a benchmark or a certain objective. So that's really what we're trying to do, is grow people's capital at an acceptable rate while taking acceptable levels of risk. And so obviously this year, a lot has happened in the global economy, and that has impacted or just had investment implications, which impacts your retirement funds, your unit trusts, your savings, the value of your property, so on and so forth. So we'll just touch on a few different things. Just give me a moment to connect to my presentation. Okay, I hope everyone can see the slide deck that has just come up. So I'll try and be as concise as possible and leave as much time open for Q&A, because we would like this to be interactive, and hopefully there will be some questions that do come out of this. Just in terms of an overall summary, we'll start with the global picture, and then we'll go down to the South African picture. But if we use the coronavirus metaphor in terms of a patient, coming into the year 2020, the global economy was reaching, the late cycle of the business cycle, the late phase of the business cycle, rather. And whilst the pandemic obviously had a significant impact on the economy, given that globally the economy was still in a relatively good shape, growth was looking at around 3 to 3.5% globally. Obviously, the majority of that coming from emerging markets, whereas South Africa, on the other hand, was already in a technical recession coming into the year. So just extending that metaphor, it's almost like you had a patient that was already suffering from certain ailments and then got hit by this new virus, which almost knocked the patient out as far as South Africa is concerned, whereas the global economy started off healthy and was able to recover relatively quickly. So if we just look at the overall performance, but starting with the backdrop of coronavirus, what exactly have the implications been? The two charts which you do see are looking at daily figures. On the left, daily infection rates, and on the per million, so daily infection rates per million of the global population, whereas on the right, daily mortality rates per million of the global population. So what we can see is clearly the global lockdown, which came into effect after Q1 this year, so during March and April, did have an impact on dramatically slowing down the trend rate in global infections. And this obviously meant that hospital capacity was alleviated, and so there wasn't a critical shortage of ICU machines, and so hospitals and the healthcare sector were able to deal a little bit better with the pandemic. On the right, in terms of fatalities, obviously the picture was a lot more severe, even during the lockdown phase, and this just speaks to the particular nature of the virus impacting certain at-risk groups a lot more, such as the elderly. And so you saw a lot more deaths initially, especially in countries that have a high segment of elderly in their population. So you're looking at, Western Europe, certain places in East Asia, North America, for example. And that has come down significantly, despite there being second waves and the virus mutating. And this suggests that to some extent, it may be herd immunity. It may be the fact that the most vulnerable have unfortunately already succumbed. But even though infection rates continue to spike, mortality has stabilized. And a lot of that also has to do with the relatively low mortalities we see in emerging market regions like Sub-Saharan Africa and South America. And in terms of economic consequences, there have been quite a few. But if we talk from an investment or business landscape, the virus and the subsequent lockdowns have impacted various sectors differently. And so you've had this phrase of COVID-proof business models or sectors arising in capital markets. We're talking about in industries in ICT, technology, telecommunications, various segments, sub-segments of technology, as well as consumer staples like basic agriculture and as well as food staples. Those sectors have been relatively unaffected by the lockdown measures because their businesses have been able to operate more or less as usual. Some of them, such as e-commerce, social media, online media, have in fact accelerated significantly during the lockdown because a lot of their bricks and mortar competitors have been shut down. The opposite is obviously true in industries such as oil and gas, for example, consumer discretionary, that's your clothing, your durable goods. Those property, those industries have been severely impacted, retail in general. And I mean, this makes sense. Obviously, if people are locked down at home, they're unable to visit shopping malls. Discretionary spending takes obviously a back seat. A lot of people obviously suffered from unemployment, obviously savings increase and consumer sentiment declines. So you've had a dual almost impact, and there's been initially after Q1 there was significant sector rotation into the sectors that were benefiting and out of the sectors that were suffering. Just in terms of the winners and losers, and unfortunately, events like this do lead to winners and losers, not just on a company or industry perspective, but also on a country perspective. And the chart over here is really showing supply of vaccines that are currently in phase 3 trials and which countries have secured supplies. And this is in terms of doses per capita. Now, most of the vaccines under development will require around 2 doses to reach some level of immunity for a certain period of time. And so obviously what each country wants to do is ensure that they have at least double the number of doses in terms of their population. So for South Africa, for example, you would want more or less at least 120 million doses of an effective vaccine. And what we can see there is clearly the advanced or developed nations have secured most of the supply. And this speaks to obviously the gulf in resources, shall we say, between developed nations and developing nations. Obviously, certain countries, for example, China has pledged to supply vaccines to emerging economies globally at an affordable rate. So that may ameliorate the situation to an extent. But a lot of the companies that are in phase 3 trial, especially Western pharmaceutical companies, are obviously going to produce these vaccines at market-related prices. And so in 2021, you're likely to see a lot of vaccines going to Europe and North America and parts of East Asia. Well, not so much East Asia because they've done relatively well in or reducing infection rates. And so, whereas Sub-Saharan Africa, Middle East, Latin America, South Asia will still see rising infection rates. But luckily, those regions have relatively younger populations, and so mortality rates aren't likely to increase significantly as a result. In terms of growth outlook, in this chart obviously showing the severity of the impact of the lockdowns on economic activity. South Africa in the second quarter shrunk by 17% on a year-on-year basis, whereas the US shrank by about 31% in the second quarter on a year-on-year basis. So those are significant and very, very sharp moves. And obviously, what people in the market are obviously looking for is how quickly will economies rebound, especially in Q3 and 4 of this year, to set the stage for next year's economic recovery. And that obviously has implications in terms of general business activity, company earnings, which then impacts on company valuations, and then that impacts on the value of your savings, your retirement funds, and your unit trust. So everybody is looking towards data that will signal whether or not we're looking at a V-shaped recovery or more of a U-shaped recovery in terms of the global economic outlook. What has been already evident is that China, for example, has done relatively better than most other economies, and this is probably because the impact of the lockdowns was in Q1 of this year for them, whereas it was in Q2 for most other regions, so they've recovered quicker. So out of all the major economies, China will be the only one that prints positive GDP growth in 2020. And the rest will have to wait for 2021 or even 2022 to reach levels which they were at in 2019. In terms of global equities, you can see again that very sharp V-shape over there. And obviously economic growth or GDP and equity returns are closely correlated, although equities are usually a leading indicator because markets always tend to look forward. And so when you look at global equities, and the chart here is really showing total returns of MSCI World, which is an index representing all global equities, as well as emerging markets, MSCI Emerging Markets, which is all the regions excluding Western Europe, North America, Japan, for example. And really in March this year, obviously that massive drawdown, the fastest period to a technical recession that the world has ever seen. And that obviously shows the severity of the downward trend. So markets reacted very quickly to the initial lockdown regulations in Western Europe. Once the virus had hit Italy and Spain, people realized it was becoming a global pandemic, and that led to massive selling off, not just of bonds as well, which is something historically has not really happened before. And until central banks stepped in and started monetary easing and putting a lot of printing money and placing that into the system, buying ETFs, buying bonds, and general equities as well, to try to stabilize capital markets. Until that happened, markets were really in free fall, and was the fastest technical recession that we have seen in history. So in terms of the immediate impact, it was worse than what we saw in the great financial crisis of 2008, even in 1929 with the Great Depression. Obviously, the recovery was a lot quicker than those instances. Here, without, I guess, getting into too much technicality, what this chart is really trying to show is that the impact was really felt mostly on smaller cap shares relative to larger cap shares. So I mean, the blue line is showing the large cap US companies, whereas the line at the bottom in orange is showing equal weighted global stocks, obviously less emphasis on large caps. And larger cap companies with stronger balance sheets were able to weather the storm better. And I mean, this makes intuitive sense. The lockdown measures impacted on small and medium companies a lot more, which had a lot less cash on hand to keep staff employed, to pay off debts, to fund working capital, so on and so forth. And so a lot of the unemployment that we did see from the lockdowns globally was from small companies laying off workers, whereas most large companies were able to maintain basically their expenses throughout the lockdown period. This just talking to what I mentioned a few slides ago in terms of the quickness of the recession or the bear market and the recovery. The blue line really showing the average recession or bear market in equities over the past few recessions, going back a few decades to the 70s. So usually what happens is, you know, it takes quite a while for the economy or for the market to recover to its prior level, and we're talking about usually about 18 months, 1.5 years for that to happen. Whereas what happened in March this year is the market fell by 30%, and within a few weeks it had recovered almost completely. So this also talking to the changing dynamic of capital markets, the rise of algorithmic trading, a lot more liquidity, the rise of passive investors. That changes the landscape of the markets as well. So things happen a lot quicker, and there's a lot more volatility as well as compared to historical bear markets. No need to spend a lot of time here, but just showing the same slide I showed before in terms of global developed markets and emerging markets, just adding the orange line there, which is the JSE, so South African equities. And South Africa has underperformed global equities, has underperformed emerging market equities during 2020. And reason being, as I mentioned before, coming into the year, we were already in a technical recession. There were significant capital outflows out of our markets from bonds and equities, so both asset classes. And so this pandemic just really exacerbated the existing issues, and obviously concerns around the fiscal situation, which we do find ourselves in. Our relief package, most of it was not in fact new stimulus, but rather repackaging of stimulus. And so the ability of government to keep the economy afloat through this pandemic, obviously not being as strong as what you saw from, for instance, the EU or the US. And so global investor sentiment towards South Africa at the moment is quite weak. We are on a low growth trend, and that obviously impacts on company profitability and also on sector multiples. So, you know, relatively speaking, our markets are undervalued. We've got higher bond yields, we've got low equity multiples, but there are reasons for that, unfortunately. Here, just taking the JSE equities in blue and the black line being the banks index. And what we've seen globally is that the banking sector has been one of the laggards in terms of performance this year. And the impact of coronavirus is that obviously a lot of banking customers have been unable to pay back their debts, which they've taken from the banks. And so that has implications for rising bad debts and the credit loss ratio cycle. And so investors have been very pessimistic on the banks, despite Basel III Accords and, you know, CET1 ratios being very comfortable. The banks are very well capitalized. However, the market is concerned around rising credit losses, because remember, all of the shopping malls that are empty, those malls have debts which they raise from banks. All of the retailers that are not trading or were not trading, they have debt which is raised from banks. banks and a host of other industries as well. And so obviously a major concern there from the investment community around the banking sector. And that came through in terms of banks being sold off and trading at historically high multiples to NAV and high dividend yields, obviously dividends not being paid this year as a precaution. So we've already said that the JSE has relatively underperformed global equities in 2020. And unfortunately, it's not just a 2020 phenomenon. Over the past 5 years, JSE equities has underperformed. And that has implications for Regulation 28 portfolios. Most of your retirement funds can only have a maximum of 30% of their assets offshore. And so 70% of your money will be invested in South African assets. And if South African assets continue to underperform, then obviously that has implications for your ability to retire comfortably in the future. And so that is something obviously that business community, the investment community and government are all concerned about. And, there are calls for structural reforms that will boost the trend growth of the South African economy and thus boost asset prices over the long term. But just in terms of breaking down that all share return, and this was looking at the specific period up until the lockdown and the most severe aspect of the lockdown, so halfway through the year. When you exclude the gold sector, mining, as well as Naspers and Process, which have a large weighting generally in our equity indices, you see that the rest of the market significantly underperformed. And so whilst the lockdown, like I mentioned, impacted a lot of industrial sectors, mining companies, gold, precious metals, which are often seen as a safe haven, did perform strongly. And Naspers and Process, obviously through their investment holding in Tencent, performed strongly during the pandemic as well. Obviously Tencent and a lot of other internet companies globally performing well. So this just shows the extent of the situation when you exclude mining and Naspers from the JSE in terms of the relative downside that we did experience. And not just in equities, obviously in bonds, we'll touch on that a bit later in terms of bond yields and obviously in terms of the currency as well. From a commodity, and I'll try and just pick up the pace so that we have a lot of time for Q&A. I mean, just from a commodity perspective, the orange line being iron ore, and I mean the reason iron ore is traded so strongly, obviously that being the Dalian iron ore exchange price, that market is controlled by the Chinese economy. Obviously their demand for steel, given their large infrastructure programs, means that even during this period there has been a strong demand for base metals like iron ore and copper, and infrastructure being one of the ways that the Chinese government has stimulated their economy, as opposed to monetary stimulus that we saw from the Europeans and from the Americans and the Japanese. The blue line being Brent crude. I'm sure all of you remember reports in April of crude prices turning negative. That's something that has never happened before. And if you had to ask anyone before that happened, was it possible for a listed price to trade at a negative value? People would have said, no, that's insane. But essentially, crude oil producers were paying customers to take crude oil off of their hands. Reason being that inventories globally were full. There was excess crude in the market. If you recall earlier on in the year, OPEC had a dispute, particularly between Saudi Arabia and Russia, in terms of setting production levels for crude. And following that, both Saudi Arabia and Russia significantly increased their productions of crude. And so the price of Brent crude per barrel fell from around $65 down to the $30 mark. And there was a lot more crude in the market, and then soon after that, the world went into lockdowns. Obviously, petrol demand collapsed as well. And so there was no buyers for this crude. And so inventories and stockpiles started increasing rapidly, to the point where even ocean liners and tanks on sea were full, stocked with crude oil. Eventually, there was nowhere else left on the planet to store crude, and so producers were left with no option but to actually sell their produce at a negative value. And so really 2020 has seen a lot of crazy things in a lot of different ways, and in capital markets, that has been no different. Precious metals, and we don't need to linger here, but obviously gold seen as a safe haven. Gold price reached record levels this year, reaching the $2,000 per ounce level. And in historical crises, people do flock to gold. This has it's always held a historical, I suppose, affinity for humans. Doesn't matter where you come from, and gold and platinum and other precious metals have done relatively well this year. There are new assets like cryptocurrencies. Believers in cryptocurrencies will tell you that Bitcoin is also a safe haven asset, and has a low correlation to traditional assets. And so in future generations may view cryptocurrencies the way that they view gold and precious metals. Just in terms of bond yields, this is a long-term story, just looking at different countries and bond yields. And this is one of the reasons why asset prices have been very strong for a couple of decades. Just to simplify, there's an indirect relationship between interest rates and asset prices. So when interest rates go up, asset prices go down. When interest rates go down, asset prices go up. And since the 1980s, most central banks around the world have been lowering interest rates from the record levels which they were at in the late 70s due to stagflation. And so the big concern there was obviously running away inflation. And by hiking interest rates, I mean, in the US, they reached around 20%. Whereas today, interest rates are around zero in most regions or developed market regions in the world. And so that gradual reduction in interest rates over time has led to rising asset prices. So it's almost an artificial lever that has boosted capital markets for a long time. But obviously from the current base, when you're sitting at German 10-year government bond yields at negative 0.6%. In other words, you would pay the German government to take your money from you. And obviously this is untenable for a lot of institutional investors in Europe, which is why they go hunting for yield in emerging markets like South Africa. So even though South Africa has credit risk, and obviously we're now sub-investment grade, the fact that our real yields, which is our nominal 9% yield less our inflation, are very attractive compared to other countries in the world, especially Europe, the US, Japan. You get global investors who need income for their mandates. They invest in bonds in emerging markets like South Africa. And here just showing the SA bond yield story. I mean, our bonds touched 12% earlier on this year. This is a 10-year government bond, so the rate at which the South African government has to borrow money to fund its expenses. And this touched 12% until the Reserve Bank stepped in and committed to being a buyer of government debt temporarily, although they didn't want to call this QE. It was really a mechanism to protect the market after the Moody's downgrade and after the lockdowns were put in place and market making was a bit impaired. So we're back now to around the 9% level, and this is very attractive for global investors. Despite concerns around the fiscal situation in South Africa with debt to GDP looking likely to continue increasing over the next few years, and obviously government committed to SOE debts, for example, like Eskom. So despite those concerns, the fact that you can make good yields investing in countries like South Africa, whereas you can't in European countries, US or Japan. This makes the market very attractive for global bond investors. Whereas the opposite is true with equities. There are a lot of other equity markets that are looking a lot more attractive than South Africa at the moment. So, I mean, I am cognizant of time, so I think we can stop there and go into Q&A. There is still quite a bit that I could touch on. So, Monde, I'll take a cue from you in terms of should we wrap up and move to Q&A, or should I continue and touch a bit more on the SA situation and the rest of the presentation?
Thanks, Tato. I think it would be beneficial to briefly touch on the South African context. You've given us the global view. I think if you were to touch on the key issues just domestically, and then we can head into Q&A.
Okay, not a problem. All right, I'll just go through these slides very quickly. Here, just this is just the Federal Reserve balance sheet in the US, and one of the benefits of having the global reserve currency is you're able to literally print money to pay for all your expenditures, and this is why the US is able to maintain a structural deficit in terms of trade deficit and budget deficit, because the rest of the world demands US dollars. Most assets are priced in US dollars, and US government bonds are seen as a safe haven. So this year alone, the Federal Reserve printed over $3 trillion. And this is literally just money which they created out of thin air, and they use that money to send basically income grants to American citizens on a monthly basis, those who were laid off from their jobs. And so, this is it's been called the exorbitant privilege of having the global reserve currency. No other country in the world can print money out of thin air and just send it to people's bank accounts because they lost jobs. So, so obviously, again, talking to how different countries have different abilities in terms of dealing with various crises and recessions. Let me just skip through these slides and go to the local context. So in South Africa, if we just have a look at confidence levels, the blue line being South African business confidence and the black line being South African consumer confidence. Now, these surveys have been going for longer than I've been alive, but here just showing you from the 1980s up until now, business confidence and consumer confidence are at the lowest levels that they've been since 1985. And to put that in perspective, 1985 was the year of the Rubicon speech, when then Prime Minister Botha said that apartheid will not be ending anytime soon. You had global sanctions being placed on South Africa, and multinationals were pulling money out of the country, and there was a threat of a civil war. And I mean, there were a lot of bad things happening in 1985. But the point is that South Africans are now as pessimistic about the future of South Africa as they were back then. And that obviously has a lot to do with the deteriorating economic outlook we've seen over the last 5 years. I mean, we saw today from Stats SA that unemployment, the narrow definition is at about 31%, but we really should be looking at the expanded definition, which includes discouraged workers, and that's at around 43%. So 43% of South Africans cannot find work and have given up searching for work. Youth unemployment at 61% is a very concerning figure, and this has social implications in terms of inequality, in terms of unrest and potential conflict going forward. And so that it really is something that government, business, and the investor community needs to, and the labor movement, all the stakeholders need to come together to find a solution to youth unemployment. Historically, if you look at any countries that have gone through, whether it's revolutions or significant civil revolt, youth unemployment is always a major indicator. It's perhaps just a psychological thing, but when there are a lot of young unemployed people, especially those who have tertiary education, this was really the spark for the Arab Spring, which we saw 10 years ago in North Africa. It wasn't started by workers or by disaffected groups. It was by university-educated graduates who could not find work. And once a country reaches that stage, there are significant political implications. So it is something that a lot of people are concerned about. In terms of consumer inflation, this is one positive aspect. This has been trending downwards, well within the Reserve Bank's 3 to 6% band. Obviously, some of this comes from lower demand and obviously supply chain disruptions, meaning that capacity has been reduced recently, and so there isn't significant demand, and so there's no pricing pressure. The benefit is obviously that if we do see a sharp recovery, inflation is not really a concern because there's a lot of excess capacity in the economy to grow into. We touched on this earlier, just in terms of valuation of South African equities. So whilst compared to history, they are one standard deviation below average historical values. PE multiples are driven by factors like interest rates and obviously earnings growth going forward, and payout ratios. And if you look at those three measures, well, we've seen interest rates come down, and that's positive. So 300 basis points cuts this year. The other two measures, the payout ratio has increased significantly, and the earnings growth has declined significantly. So by payout ratio, basically how much money, so companies make a certain amount of profit each year. How much of that do they reinvest in the business? How much do they pay out to shareholders as dividends? And South Africa's payout ratio over the last 10 years has increased significantly, meaning there's been far less reinvestment into the economy from companies. And that obviously has implications in terms of capital formation, new business development, research and development, and so on and so forth. So that means that obviously companies are not reinvesting, and we've seen this from companies paying out high dividends or making acquisitions overseas rather than investing locally in the economy. And that has had an impact. And over here, just in terms of earnings growth, and I mean, this is really what drives equity markets, and whatever portfolios or retirement funds that you're invested in, chances are the majority of your money is invested in equities. And over the long term, equities are driven by profits or by earnings growth. And South African listed company earnings growth has been relatively muted for quite some time. If you look at the 5-year moving average in black, that shows you that real earnings have not really been growing for the last decade. So South African companies have not been generating sufficient profits to maintain their valuation levels or to reinvest. And that obviously is a concern. And when global investors compare South Africa to other emerging markets, whether it's Brazil, India, whatever the case is, we score very poorly on economic growth and on company earnings growth. So in terms of the summary there, obviously equities cheap, but obviously company earnings growth not looking too promising. But obviously if we have a sharp recovery, that obviously changes the picture. But that sharp recovery is contingent on a vaccine being readily available for the entire population. So having that inoculation so that the threat of lockdowns is reversed completely. Second, secondly, those who've lost jobs being able to quickly find new jobs. So small business formation or loan forgiveness for businesses coming into play so that they can rehire quickly. All of those factors are needed. Obviously, from an export perspective, we'll continue exporting chemicals and minerals to, for instance, China and other regions. And that obviously does have a positive impact in terms of export earnings and supporting the currency somewhat. From a bond perspective, our yields look very attractive to global investors, although there is credit risk. The South African government is borrowing anywhere between I believe around 4 and 5 billion rands a week this year so far, whereas before they would borrow around 2 to 3 billion rands a week from the markets. And so they've had to borrow double as much as they were before to basically fund the budget deficit. And obviously long term, the sustainability of that is in question because you're now spending more and more of your budget paying back interest from people you've borrowed from, rather than spending that money on healthcare or education or infrastructure, for example. And property has been one of the worst performing sectors in the world. Actually, South African property in the first half of the year was the worst performing asset class in dollars globally, out of the traditional asset classes. And for the past decade, South African property has been a relatively strong performer. But what you see in a classic property cycle is that prices are increasing. A lot more companies raise capital to build more developments, so that shopping malls, office buildings, residential complexes. The economy starts to slow down. By the time all of these plans are built, there aren't enough tenants, and then there's a lot of pressure on pricing. The developers took out a lot of debt to build all of these projects, and so they need to repay this debt. So their balance sheets are stretched. And what's happened in 2020 that's put a lot of strain on property companies is that most of them are obviously listed as REITs and being real estate investment trusts, which means they're tax exempt, so they don't pay tax, but they have to pay out at least 75% of their earnings as dividends. And the purpose of that is you have a lot of investors, especially retirees, who rely on income from their portfolio to fund their daily lifestyles. And so the property sector is very important in that. But given that a lot of tenants have been under lockdown, and so they weren't generating revenues, they weren't paying rentals, so the property companies couldn't pay off their debts, they couldn't obviously distribute capital to shareholders. So ideally, they would have liked to suspend their dividend payments to pay down their debt and to strengthen their balance sheets, but they couldn't do that, obviously, because they would lose their REIT status and then they would no longer be tax exempt. And so the sector was under a lot of strain, and then also the fact of lowering prices means their asset values have declined, which led to impairments on their balance sheet. So the property sector was under quite a lot of strain. So that was really just a summary of the South African picture. Relatively speaking, to the global to global markets, cheap, but there are concerns that investors have. So I mean, with that, I'm happy to end, and you can go into Q&A.
Thank you very much, Tato. Thank you for that comprehensive outlook globally, and also the domestic picture as well. Obviously compounded about what's the stats that we got today, which you have mentioned, and the Arab Spring, is quite concerning as well. Just to kick start the Q&A, let's start with the first question here. At Tato, what's your view on gold stocks going forward? Do you think the metal will continue to be attractive as the overall equities recovers?
Yeah, thanks for the question, and that is a good question. And you may want to separate, I guess, between the metal and the actual companies. And the metal obviously is seen as a store of value. And so when equities rise, the gold price will tend to fall, and vice versa. When equities fall, the gold price will tend to rise. And so when people are afraid or there's a lot of uncertainty in the markets, gold tends to do well, because now people don't know what the outlook is. We're in lockdown. How long is the lockdown going to continue? When will vaccines be readily available? When will life go back to normal? We don't know, and so we can't forecast. And so people have low confidence in their ability to assess future earnings of companies, or the ability of companies that have raised debt to pay back their debt. And so that's why people then move to gold. The gold companies obviously benefited from a rising gold price. And remember that for a gold miner, the two factors which impact on profitability more than anything are the dollar gold price, as well as the rand dollar exchange rate. And both of those went in their favor this year. The gold price increased, and the rand depreciated against the dollar. So the price at which they were earning in terms of dollars and gold were increasing significantly. So they made so their earnings increased significantly as a result of that. So gold miners did exceptionally well while there was all of this uncertainty. But this past week, we've seen a reversal in that, because on Monday, Pfizer, which is one of the companies that has a vaccine in phase 3 trials, they released very positive data showing that their vaccine candidate is effective in 90% of cases. And so people expect that their vaccine will be rolled out relatively quickly. And there was a lot of selling off of gold miners, also of internet companies, and people started buying your traditional base metal miners, your consumer discretionary companies, your travel companies, because now the expectation is that the economy will recover sooner than what we expected. So going forward, if you want to, invest in gold miners in the short term, you have to take a view on, you essentially have to take a view that people are being too optimistic on the vaccine rollout.
No, thanks for that, Tato. Here's another question. For a young investor, is it still worth putting money into my retirement fund, or should I look for other retirement options?
Yeah, Stuart, take that one. Yeah.
Okay, no problem. So I think there's a few points there. The one point to make is as a young investor, you certainly are doing well if you're starting to save towards retirement. Remember that the one basic principle is to start early. Your earnings capacity, when you're younger, is probably not as big as it's going to be. So as it develops, it broadens the optionality for you in terms of your portfolio, and then you can start looking potentially to diversify, into parts of the market that potentially offsets your domestic exposure, for example. So you probably will have a property asset to offset, and you can do that by investing offshore later on. But I think early on, and just as a rule of thumb, make sure your retirement savings are there first and foremost, and build that, and then you can look at other investment options through your advisor or portfolio manager. And there's also tax benefit to do in doing so. There's incentive to invest into retirement funds. You've got a tax deduction in terms of your contributions every year that will help you in terms of your overall tax bill at the end of the year.
Sure. Thanks, Stuart. Tato, you don't know weigh in on that one, or you're fine?
No, I think Stuart answered that quite well. I mean, as a young investor, you've got decades ahead of you, and no matter what the current situation is, over time, your portfolio is likely to appreciate significantly.
Sure. As dealing with this specific issue of starting early, I mean, if you go back to some of the stats that you gentlemen have quoted, if only 6% save enough, to retire comfortably, what do you honestly think are the real challenges with that number, and where actually should it be pitching in South Africa as an emerging market?
Should I do that one, or Stuart, do you want to do that one?
Yeah, Stu, would you mind taking that one? I think you've had more look at the stats than we have.
No problem. Look, I mean, it's a lot of it's got to do with there's a lot of pressure on the consumer. Unfortunately, the stats don't talk to a lot more than people accessing money in between jobs, and when they get retrenched for the wrong reasons. But it's fine to say they're the wrong reasons until you walk a mile in someone else's shoes. So in some instances, it's to pay down debt. In other instances, it's to buy a car. These are disciplines that take away from being able to, or the wrong disciplines, should I say, that take away from being able to retire well. And I think the culture of it needs to improve. So if we can get that right, and it's also understand the demographic that we live in, and the fact that for many South Africans, it's a case of a paycheck feeding a family and surviving as opposed to saving. So that 6% number maybe. But that 6% number is on a survey of people who are saving and who are earning an income. So it is a concerning number, and I think I think given a high inflation rate and a high cost of living, unfortunately people access that retirement money when it should be sort of locked away for retirement specifically.
Here's another question at Tato. What would your advice be on the vehicle to building wealth? Would you advise to use one financial institution or more?
I suppose it depends on, are you starting with an advisor, in which case usually you would have one point person who you build a relationship with, and that person has an understanding of your overall financial position. So in terms of all your various assets, whether it's property, so they can view your whole balance sheet, your debts, your properties, your retirement funds, your discretionary funds, other cash, and so on. And ideally you have a plan, an investment plan, which usually is called an investment policy statement, just setting out what are your objectives. And I mean, your financial objectives are really tied to your life objectives. So what sort of life do you want to lead? When do you foresee yourself retiring? How many dependents do you have? Do you want to be traveling? Do you want to have a nice house one day? Do you want to send your kids to a nice university? All of these things form part of your life plan, and they filter through into your financial plan. And from that financial plan, you most likely are going to, with your advisor, contact bunch of different institutions to implement this plan. So the relationship with your advisor, it's kind of it's one-to-one. You're not going to have multiple advisors, but in terms of implementing the plan, so your asset allocation and how you allocate your wealth, over the next few decades, you'll likely have different institutions managing different parts of your overall portfolio.
Here's a question for Stuart. What's the best retirement option between provident fund and pension fund?
It's a good question. I've always preferred the provident fund, and Stu can jump in here as well if he's got.
Yeah.
You happy to take that one?
Yeah, I am. Yeah. With regard to, I think going forward, I'm not sure if you know that they are changing legislation 1 March next year. So in effect, it's not going to matter what you choose, whether it's provident or pension fund, because government has always been worried about the fact that obviously with the provident fund on retirement, you could access your full amount of money, and they've been pushing towards what they call annuitization, where very similar to pension, where you could get a maximum of 1/3 and then 2/3 had to give you a pension. So from 1 March, if you are under 55 years of age, you automatically are going to go into the annuitization thing, which will be like a pension fund, where you can get a maximum of 1/3 and 2/3 then have to buy you a pension. But if you're over 55 and you're not yet at retirement age and you're in a provident fund, then you'd be able to continue on that basis. So unfortunately, right now, if you're under 55, the benefit of either one is actually falling away. I don't know if that helps. I don't know if that answers the question.
Yeah, I'm sure it does. I mean, just to expand on that, and thanks, Stu. The difference used to be that the provident fund offered you a little bit more liquidity, prior to retirement, if you needed it. But with that change coming in March next year, it'll be like for like, and you won't really have a difference.
Thank you for that. Here's another question. What would be the best long-term strategy to invest overseas?
Tato, I think you can take that.
Sure. I mean, there's various ways of investing overseas and through various structures. I mean, if we start with compulsory money or your retirement fund, your retirement fund is governed by the Pension Funds Act, and one of the clauses in that act, Regulation 28, which sets out guidelines in terms of asset allocation. And the purpose of those guidelines is to prevent an investment manager from taking excessive risks or having too much concentration of a retirement fund in a specific assets or security, for example. So in terms of retirement fund money, whether that's pension or provident fund, you can have up to 30% offshore. In terms of your own discretionary savings, whether you save money for in unit trusts or whether you have brokerage accounts and you invest directly through those, you can have as much as you want offshore. Obviously, that's limited by your reserve bank allowance. So you have a 1 million rand per annum discretionary allowance that you can take offshore. That's money that you can use to invest offshore. You have another 10 million allowance, which you have to get permission through the Reserve Bank to take offshore. So up to 1 million, you can just take offshore as in how you please per annum, but up to 11 million, you can take offshore per annum with a Reserve Bank clearance, and that money you can then use to invest wholly offshore, whereas in your retirement funds you're capped at 30% offshore. And how you can do that, I mean, through various channels. You can do it through unit trusts, which are fully invested in offshore assets. You could do it through opening brokerage accounts through, for instance, your bank, and you have online and mobile trading platforms, and you can buy direct instruments offshore. You can do it through your wealth manager, and they can allocate to various third-party managers that will manage your money offshore. So there's various ways of doing that, or you could open an offshore bank account. You could travel to whichever country you want to invest in and buy a property there. That's obviously a more direct way, or more manual way. So there's various ways of investing in different assets offshore.
And maybe if I can add, and that's why it has to be such a broad answer, because it's going to be specific to the individual, and it's going to require sitting with you, going through your profile, your needs analysis, the life plan that Title referred to give you the best answer there. One individual's ideal vehicle may be very different to another's, just depending on their appetite, the investment horizon, and what they can commit to.
Thanks, Stuart. Thanks, Tato. We're also mindful of time as well. We don't want to overstretch the attendees and also the esteemed panel as well. So maybe we'll just give it a few more minutes. It's 7:25. I think let's agree we'll not go beyond 7:30. So let's try to take maybe another one or two inputs from the floor. If there isn't, maybe we can ask Stuart Spies to kind of add to what has already been discussed. But I'm not seeing any new questions coming from the floor. I'm checking again. Yeah. There's currently no new questions. Let me maybe throw one at you, gentlemen, as we maybe wait for one more question from the floor. As you reflect on the domestic issues in South Africa, especially with the plan around the recovery plan of government, how do you think it will fare, especially in your industry as well, and how it will impact your industry as well?
Look, I think Tato, I'll look from an individual sort of planning point of view. If you can look at the overall sort of broader economic situation, I think the important thing one needs is to understand that people are going to moving between jobs a lot. I think it's going to be that situation. You're going to get work, you're going to move, you're going to get work, you're going to move. And it goes back to, unfortunately, what we've seen happening is that people need to live. So they've been taking the cash from their retirement funds. And it's a difficult thing, because it's all very well for us to come with theory and say, yes, you have to keep, you have to protect your retirement capital. And that is absolutely true. But you've also got to survive. So it's going to be a very difficult couple of years going forward, I think. People are going to battle. People are going to have to see what they can do. Ideally, one needs to try and save as much as you can. Try not access your retirement funds, but life happens, and that's the reality that we're facing with. So I think going forward, it's not going to be easy. Where possible, people must try and, within affordability, try and contribute as much as they can to the retirement fund, and if at all possible, moving from one employer to the next, because people are portable, is to try and preserve what you have. But it's not always easy. It's not always possible, unfortunately, because we are faced with a really difficult situation, which I think Tato alluded to in his economic presentation. That's perfect.
I mean, from my, I suppose, perspective, the issue isn't so much around the planning, but more around the implementation. I think government has produced a lot of good plans over the years. You know, you can go back to the RDP in the 90s, GEAR in the noughties, you know, ASGISA, NDP, obviously a bit more recently. But those are all good plans, but the problem comes around the implementation of the plans, and is there, you know, buy-in from all of the various stakeholders in society to push ahead with structural reform? And this is always what separates countries that continue to grow from those that don't. You know, just as, you know, businesses go through life cycles, so do countries. And South Africa at the moment finds itself in a middle income trap, which means we're not able to move to the next level of growth and development because there are certain restraints and in our economy which need to be changed for us to move to a higher growth trajectory. And without changing those, you know, business confidence will remain poor. And if business confidence remains poor, you don't get gross capital formation. And without gross capital formation, your infrastructure doesn't improve, your unemployment rate doesn't go down, and the growth doesn't return. So at the moment, you know, we know that government's balance sheet is quite stretched. So any sustained recovery in South Africa needs to come either from the capital has to come from business sector, or it must come from global lenders, because at the moment government isn't unable to fund a recovery in South Africa. And so to get businesses, and you'd rather have businesses investing rather than borrowing money from the IMF or bank, for example. So unfortunately, you have to have that conversation with business to say, what is it that you require in order to invest in South Africa rather than taking money offshore, rather than paying money as dividends? And you know, what you need the things that most of us are quite familiar with, you know, improvements in infrastructure, improvement in the skills base, certain policy reforms that bring flexibility to business. Once you have that, you get more capital that will be released in the economy. And my personal view is we should be focusing on export-orientated industries, those that can earn foreign currency, because that, you know, you get more bang for your buck in terms of reinvesting foreign currency, and not just in minerals, specifically in manufacturing. And you know, manufacturing is how every poor country became rich. Whether you look at all the Asian tigers in Asia in the 20th century, or in the 19th century, countries like Germany were relatively poor countries. America in the early 19th century was a poor country. They all developed through through labor-intensive manufacturing, because when your factor endowment as a developing country is steered more towards low-cost labor. We do not have a population of PhD scientists who are working in laboratories. The majority of South Africa's labor force is unskilled labor, and you need to put that labor to work. And the best way of doing that is through manufacturing and setting up zones where manufacturers can export efficiently, but that requires infrastructure, it requires flexible labor. And so those are difficult conversations to have with stakeholders. So really that's what the business community and the investment community would look towards before allocating capital to South Africa.
No, thank you. No, thank you very much, Tato. I think, gentlemen, we did say beyond 7:30 we'll try to cap it. So what I'm going to require from you is maybe a last bite, all three of you, maybe 10, 15 seconds. What is the last thought you can leave us with for now? Of course, BMF will continue with these engagements and have continuous series and education around, you know, retirement and savings. Of course, this being the first as well, and continually build our relationship with Graviton and Sanlam as well. So as we close, what would be your last thought for our members and for us to go home with? So maybe we should We'll start with Stuart Spies and Stuart May, and then we'll end with Tato.
Yeah, I think from my side, being an advisor with Graviton, we did mention that it's important to plan. And if there's somebody that's on the call tonight that's interested in sort of trying to understand what the whole cash flow and whole analysis and everything looks like, Lungisa and I are happy to actually come and see them and chat and then start them on the journey. You know, it's never too late to start. You know? And that's exactly what Stuart was saying earlier. Plan, and we can look at things and we can get people to understand what they need to be looking at. I'm very happy to assist with that. And they're under no obligation to do anything. We're just there to assist and help people understand where they're
going. Thanks, Stuart.
Yeah, just to thank you again for the opportunity. I think I think my message would be to just encourage investors and young investors to stay the course and to not be too emotional in their decisions. We've had updates from a couple of very well regarded asset managers in the last week or two, highlighting some of the good points in our own backyard. And valuations are attractive. There's some good sort of indications that government's going to deliver on what it's promising in some instances. It's very easy to get caught up in the noise and in the sensationalism in the media. I think if you've got a good financial plan and a level-headed financial advisor to bounce that off when you need to, you stay the course and you trust that long-term, equities will deliver, and you offset that as you need to with other asset classes that get you to the right outcome, the right level of risk.
Thanks, Stuart. Tato?
From my side, I'd like to thank Monde and the BMF for hosting us. And if I leave with one thought, it would just be compound interest. Albert Einstein once said that compound interest is the greatest wonder in the world. And anyone who has a job can become a millionaire. It really is a function of how early you start saving and how much of your salary you save. Anyone can retire as a millionaire if you have the diligence to save more than the required minimums, and invest wisely with the help of a financial advisor. So it's not something that should be seen as, oh, it's a problem to think about when you get old, or oh, it's something that wealthy people focus on. Start young and save a lot more than the minimums. I mean, in your 20s, you should be saving 40% of your salary. In your 30s, you should be saving 30%. And then, from your 40s onwards, 20%. And if you do that, you chances are you will become a millionaire by the time you retire, assuming you've invested wisely, those savings wisely.
Thank you very much, gentlemen. We really appreciate your time. We appreciate the relationship, and we'll continuously engage and have more sessions for our members on either side. So thank you very much for your time. We also thank the attendees that have taken the time out to come on and to be engaged on this very important subject and important principles around retirement and saving. And everyone should keep safe. COVID is still there, so let's keep safe, and let's protect each other and our loved ones and people around us. And just like Stuart Spies says, I mean, there's still a long road ahead in terms of the recovery of the South African economy. And so let's be mindful, let's be prudent on how we make financial decisions, and let them not be too emotional. So until next time, have a good evening, and thank you very much, colleagues, for your time. May you keep well. Thank you very much.
Thank you very much. Thank you for your time.
Thanks.
Thank you. Thank you, everyone.
Thanks, God. Bye.